S&P 500 is a stock market index that tracks the stock performance of 500 leading and biggest companies in the US. It acts like a report card for the US economy. If most of these companies do well, the S&P 500 stock value goes up, and if they struggle, it goes down. Some familiar companies in the S&P 500 include Apple, Lam Research, Microsoft, Amazon, Google, Coca-Cola, Walmart, and Nike. S&P stands for Standard and Poor's, which comes from two older companies, Henry Poor's financial reporting firm from the 1800s and the Standard Statistics Company from the early 1900s. They merged in 1941 to form Standard and Poor's, and in 1957 they launched the S&P 500 index to track the health of the US economy through these large companies. Today, the S&P 500 is managed by S&P Dow Jones Indices, and a special index committee decides which companies are included or removed based on size, profitability, and trading activity. The US Securities and Exchange Commission regulates the financial system of S&P 500 to keep it fair and transparent. Companies in the S&P 500 are considered large cap stocks because they are among the biggest in the US. The stock market overall is divided into categories. Small cap companies worth $300 million to $2 billion, mid cap companies worth $2 billion to $10 billion, and large cap companies worth over $10 billion. The S&P 500 focuses only on large cap companies, making it different from other indexes like the S&P Mid Cap 400 or the S&P Small Cap 600. You can invest in S&P 500 index funds or exchange traded funds using an online brokerage account. Buying one share of these funds means owning a tiny piece of all 500 companies at once, which allows you to share the growth and profits of America's largest businesses. Owning the S&P 500 means holding a balanced piece of the biggest US companies. If the majority of these companies grow, your investment grows as well. If they lose value, your investment falls too. Because of its diversity and stability,